Intel stock, INTC, is getting clobbered, causing investors to wonder, can this recover? Why is it getting beaten up so badly? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand what's going on with Intel stock. So earlier today, they reported their fourth quarter 2022 earnings results. The stock was down at one point as much as 10%, since then bouncing back a little bit. One analyst described that they had no words to describe how bad the results were, the collapse of Intel's fundamentals. So is there a potential recovery here? Because you're looking at a stock price over the last 3 years, those long-term shareholders, the buy and hold folks, looking at a more than 50% loss over the last 3 years. This is a tough journey for anyone. And so what's going on? You look at their fourth quarter and you can understand why that analyst was saying they don't have words. You're looking at revenue down 28%. That's a collapse in revenue. You're looking at their gross margins collapsing as well. Their gross margins were 44%. Previously, over the last few years, you could see it much higher. This was down 12% year over year. I really, really don't like seeing gross margins go down significantly. It usually suggests either competitive pressures or the lack of the ability to sell, their inventory, in which case you have to mark down your goods. That is not the sign of an unrivaled company when you're seeing gross margins, in my opinion, fall dramatically. And all of this translates into their earnings effectively getting wiped out, down 92% in the fourth quarter. Then you look at their guidance for the first quarter, equally abysmal, down 40%. Gross margin continues to get worse. Looking at earnings losses and looking at continued cash burn in the first half of 2023. This is not what investors want to see. So diving in, peeling back layers a bit to understand, well, what's going on here with Intel, you should understand there's several different segments. You do have, new management has come in over the last few years trying to clean things up. You're looking at cost cutting and, reorganizing certain segments, but still you have the client computing group, data center, and a couple of other divisions. And you look at what's happened, this past year, and client computing, so selling, personal computers, and data center, selling the servers for data centers, those have historically been, last few years, the core driver of their business in terms of profitability. And these two were down significantly in the year and the quarter, down 36% for client computing group and down 33% for data center. And you can see their profitability from these two segments, in the last 2 years, that was really what drove this business. And you had huge investments elsewhere. And the only savings grace, you could argue the saving grace in the quarter was, Mobileye and Intel Foundry. Mobileye has reasonable margins, but Intel Foundry is still unprofitable, significantly unprofitable for the year. And they're making huge investments here because they want to get this business up to scale. And we're going to talk about that in a second. So the only things that are growing, it's almost immaterial relative to their core segments, client computing and data center. So you want to understand, well, why is it declining so much? Because, client computing last year at $3.8 billion in profit, now only $700 million for the year. Profitability fell more than half. Data center absolutely gotten crushed from 8.4 billion in operating profit to 2.3. These are not good numbers to see. So the details that management provided, talking about these individual segments within Intel, is that with client computing, you had notebook revenues decline. Unit sales decreased 36%, driven by lower demand from consumers and education markets, i.e., the market might be a little bit saturated. You've had a lot of volatility in terms of demand the last few years. They did raise prices a bit, 15%, and they did see a bit of an increase due to the, commercial and consumer products. But overall, this is not what you want to see, where demand drops so significantly from consumers and the education market, dropping 36% for unit sales. Looking at data center, that's also a very ugly picture because they're talking about server revenue declining significantly. And they're saying the server volume decreased 16% from 2021. So this in 2022, it decreased 16%, led by enterprise customers in a competitive environment, meaning, i.e., competitors could choose other products, i.e., Intel wasn't as competitive. This is part of the reason why you're seeing the margins come down. This is not what I want to see with an investment. They talk about customers tempering purchases to reduce existing inventories in a softening data center market. This is really not good, given that this used to be one of their core profit drivers. Now, at least you might say, well, Intel historically had these profit centers, their consumer segment, their data centers, and they're making the investments so that way they can once again be a leader with semiconductor chip technology. They talk about how they're focusing on 5 different nodes in 4 years, trying to get to the 2 nanometer chip level, and they're thinking that they are still on track, this is the words from the CEO, to regain transistor performance and power performance leadership by 2025. And you're talking about a huge investment, tens of billions of dollars to get to this type of leadership with transistor and power performance. And so the question is, well, what goes on with Intel stock from here? How does it perform? Where does the stock go? Where do the fundamentals go? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Also recently launched 2 new investment courses for enterprising investors that want to learn how to either read financial statements or learn how to value stocks. And those are the 2 key areas I feel where a lot of investors got into trouble, where they just didn't know how to value things, and so they ended up overpaying during this market cycle. In full disclosure, this is not financial advice. At the time of this video, I did not own stock in Intel. So looking at Intel, a key takeaway that investors should consider is that this company is not in a great financial position. This is, an example of why it's important to be able to read financial statements, is their cash burn was significant. Now, you look at what ended up happening for the period, and during the year, they had $4 billion in cash burn. That is actually not as really a true reflection of what their cash burn was, because that includes a benefit of $4.6 billion in an equity sale. So really their cash burn from an operating perspective was closer to $8-9 billion. This is really not good for this company, and they're guiding to continued cash burn in the first half of 2023. This is not good when you're looking at a company that has a huge net debt position of $14 billion net debt. Yes, they do have cash, but they have $14 billion roughly in net debt, net of that cash, and they're still paying a $6 billion dividend. So this makes the picture even worse, because you not only have this cash burn, but then you're paying a dividend on top of it. This means that management, in my opinion, is not correctly thinking about capital allocation. How should investors think about it from here? So I have a couple of other key thoughts. The first of all, what management needs to do is they've started heading in the right direction, saying, hey, we need to make sure we do the cost cuts and focus on the products that we can actually win in. And they recognize they need to reinvent themselves. They recognize that they need to invest tens of billions of dollars to try to catch up in terms of leadership. It's a bit of a Hail Mary. We'll see if they can succeed. From a national U.S. interest, it definitely makes sense, because, there's always geopolitical concerns with Taiwan. But you're looking at a company that is not the leadership position. It is arguably far behind. You see Taiwan Semiconductor leader in the 5 nanometer, the 7 nanometer. You do not see Intel there. So the leading cutting edge chips, Taiwan Semiconductor, they have the lion's share of that market. They are crushing it. And they are not only crushing it with that, they are investing to be able to continue expanding. So, Intel's trying to do this Hail Mary to catch up. Let's see if it plays out. That's still a huge uncertainty. You have this business needing to reinvent itself. When I look at my own personal investment journey, how I want to invest, I want to focus on companies that don't need to reinvent themselves. I want to find a company that has already proven that they have a business model, that they have something that works, that their business isn't declining 80-90% in a year like their profit did this past year. But you're saying, hey, this is a business that has already proven its core value proposition. It has proven that it wins versus all these other competitors, not looking at huge gross margin declines. That's what I personally want to own. Those are the types of companies I call out to my subscribers at Unrivaled Investing. The type of company that has proven themselves, and management that's aware of what they need to do. When you're paying $6 billion in dividends, you're saying, I don't know, we have so much free cash flow coming in, we're just returning it to you as a shareholder. We don't really know where to put it. We have so much free cash flow coming in. That is not their problem, first of all. 2, they do know what they should be putting their cash flow in. They need to put all their cash flow in just trying to get back into a leadership position. So that is really important. And I think management doesn't get top marks for understanding, the appropriate, aspect of capital allocation here. I think they're missing the mark here, given that, if I were CEO of Intel for a year or whatever, what I'd immediately do is cut the dividend. I'd then set my compensation to be based on whatever the stock price is right after, because the stock price would get absolutely clobbered. So that's what I would do if I was the CEO. Realistically, focus on not only investing to stabilize, hopefully, and even potentially achieve parity with Taiwan Semiconductor. You know, like, hey, trying to beat them at this point, let's just get to parity. And then I'd try to take any of my free cash flow and repay that debt. So that way I'm not in a position where, hey, if something goes wrong for my successor or what have you, they can't put this business in bankruptcy. And when you see this type of setup with cash burn plus a $6 billion annual dividend plus net debt, that is not a formula for success, in my opinion. That is a formula potentially for disaster. So you need to see the appropriate capital allocation policies. There's a reason, in my opinion, that Warren Buffett is willing to pay up for Taiwan Semiconductor. He's not paying up a lot. He's paying something like 14, 15 times earnings for it. Maybe it's up a little bit since then, but he's paying because it's in the leadership position. They're taking share. They're creating the market for the most impressive cutting edge chips. Intel is not. Intel is constantly playing second fiddle, maybe third fiddle, and trying to catch up. So that is a key challenge. Now, if you're still bullish on Intel, that is going to require to have a belief that they will be able to get to parity with Taiwan Semiconductor, that they will be able to improve and their consumer business, their data center business will recover, let's say, back to where it was last year. So if you have faith that that will happen over the next few years, I don't have that blind faith. If you have an educated, opinion on why that will happen, then you could say, oh, wow, last year it did around $5 in earnings, a little less. The stock currently trades around $26, $27 a share, mid-20s. So you're getting something like 5-6 times earnings. So if this business could be valued as not a melting ice cube, but as something that could be a growth company in the future, then you can get, let's say, back to a 15-20 times multiple like you see with something like Taiwan Semiconductor, in which case you would see the stock up significantly from here, hundreds of % upside if you could get back there. The challenge is it's going to be extremely tough, and you have to have that fundamental belief that they can turn their operations around. That is a little too hard for me. I'm going to put this in the too hard pile. Would it surprise me to see them succeed? I'm rooting for them. I hope they do succeed. I hope the stock does go up several 100% in the following years. It's just too hard for me. I'm looking for things that don't need to reinvent themselves, that are just printing cash and saying, hey, the stock is trading at a low multiple. We can either buy back stock or we can do clever, acquisitions with it. That's personally what I want to find. With my own purchases. I'm not looking for the heartburn of like, oh my gosh, cash burn, sizable net debt, plus you're paying, like, why are you paying this dividend? And plus you're behind in terms of the technology. So Intel for me at this point, and I've called it out before, with Intel stock, even saying, hey, it might be cheap, but it's still too hard for me. This is just another reiteration that they're still reinventing the business. It's still too hard for me. Maybe that'll change in the future if they're able to catch up. If you enjoyed this video talking about Intel, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.